Tom, stockbroker. What's the present situation as far as the economy is concerned?
Well, right now we're going through a low interest rate environment, so it's pretty lean pickings if you're looking for high interest rates or some reasonable income, certainly passive income. So yeah, we're seeing that's having quite an effect on the retirees, so mum and dad investors, people that essentially rely on your interest-bearing deposits to pay their way. So yeah, it's a pretty tough environment right now. Lean pickings on the ground in terms of fixed interest, like your bond offerings, that type of thing. So mind you, at the same time, you're looking at the equity markets are doing quite well, although take out the recent market correction, and yeah, they've been tracking upwards, sort of based on that demand coming through for equities, because there are some high yields out there at the moment, and that's what a lot of investors are looking for.
You guys are talking in a totally different relationship language or whatever to we lay people. What does that mean? The fact that we're in that situation?
Well, what we've seen is the Reserve Bank of New Zealand has sort of cut their official cash rate a number of times now.
So that relates to the interest rates?
Yeah, that's exactly right. So the Reserve Bank has an interest rate in which the banks, so the major banks in New Zealand, will put funds on deposit overnight with, and then those banks will change their interest rates based on what that rate is. So we're seeing that after an OCR cut, which is the official cash rate, you're seeing that sort of trickling down into bank deposit rates and mortgage rates as well. So mortgage rates have come down, happy days for property investors, but also obviously your interest-bearing deposits are, people are having some tough times there.
I was talking to an economist this week, and he said the interest rates are going to stay low because the government's the biggest borrower and they don't want to pay lots, which I thought was an interesting twist. Tell me about the Chinese correction.
Yeah, so what happened there was essentially the Chinese currency, the yuan, it was devalued, and that was based on the mechanism in which the Chinese government, sort of based in Beijing, how they sort of essentially manage their currency. So currently, the Chinese yuan is a managed currency, so it's somewhat pegged to the US dollar. And what happened is they changed the way that it's pegged and the way it's managed. So instead of, essentially they sort of they set a fixed rate in which is the exchange rate in which they want the yuan to trade against the US dollar. Mm-hmm. And then they buy and sell US dollars to essentially get that rate around that sort of fixed rate. So there's about a 2% buffer. So they'll be buying and selling US dollars, supply and demand forces sort of kick in, and yeah, they essentially bring it in to sort of hover around that rate that they set themselves.
Because, I mean, it hit the media and it seemed as though it was going to be the end of the world.
Yeah, it's quite unfortunate that that seems to be the case quite a bit. The sort of mainstream media do like a little bit of a story on bad days in the market, and it certainly does nothing to sort of quell the fears or the panic with a lot of investors.
So people instantly went into panic selling?
I wouldn't say they instantly went into panic selling. A lot of people got cold feet, certainly amateur investors or sort of less experienced investors. So what we saw was a lot of mum and dad investors started selling out of the likes of Genesis, Meridian Energy, some of those big power companies that were IPO'd. And I think that came down to the fact that it may have been their first time in the markets. They hadn't been through something like this before. And essentially they're just trying to conserve their capital or take a bit of money out.
Which is sort of natural, really, Tom.
Oh, it's completely understandable, but at the same time, that's where essentially investment advisors earn their crust, because nothing has actually happened to the company. The company's still doing what it did a week ago or a month ago.
The dividends are still there.
The dividends are still there. In fact, because the price has dropped away, your dividend yield is a factor of both your price and the dividends in which the company's paying. So should your price drop away like it had, you see that dividend yield go up. And people can expect higher sort of yields on those investments.
And you get a massive amount of phone calls from people who are experienced and they say, when should I buy because the price is coming down? That's
exactly right. And we ring people up as well that have been looking to get into stocks that were sort of a little bit expensive, and you got your watch list or your wish list, and all those stocks have come down. They're now on sale. So essentially you go to town and you do a bit of spending. And so the only situation whereby there's a sale and not everyone's running in the door to buy. So it's sort of a bit counterintuitive, isn't it?
Yeah, it is really. I mean, it's the unloading and the giving the opportunity for other people to buy more. It's really, I don't know how you guys do it.
It is testing at times, but essentially you've just got to sort of look at the fundamentals of a company. What does it do? Are the management sort of pretty competent in what they do? And yeah, is there a future for that company? And looking at those fundamentals, if the company's great, well, that's the time in which you get in at those lower levels.
Do you find that you have to sort of hold people's hand and take them through the minefield?
Yes, especially when you have a market correction, because people ring up and they essentially want you to guide them through the process, and that's where we earn our crust. Is holding a few hands and letting people know that at the end of the day the sun will rise again. Tide goes out, it comes back in again. It's those sort of situations. You've sort of got to take the long game, a long view, because that's the way it works.
Tell me about the Dow Jones and all those other things that come up on our network news.
Yeah, so 6 o'clock news rolls by, business section crops up, they sort of flash Dow Jones and sort of S&P 500 indexes at you. What are these things? Well, the S&P 500 index and a Dow Jones Industrial Average, they're essentially an indicator of how the stock market's sort of been performing, based on what's included in that index and how it's made up. So to sort of define what an S&P 500 index is, that's the largest 500 publicly traded companies on the NASDAQ and the New York Stock Exchange.
A New York Stock Exchange?
Yeah, so they're included within this basket, so to speak, and that index is sort of tracking what's happened throughout the day. So in that basket of goods, everything might have gone up by, say, 1%, or a few will go up, a few will go down, but if the average is 1%, then that S&P 500 index has gone up 1% for the day. So it's essentially giving you a bit of an indicator of how you've gone.
And if something like the mid-80s or late 80s hits again, that disappears into the red arrow looking down, doesn't it?
That's exactly right. You see a lot of red on the screen. It's no good. But as I said earlier, it's worth keeping a bit of powder dry, because when those times hit, for a lot of those companies, not a lot has changed apart from the fact that the stock market's been hit. As long as it's not a systemic problem throughout the whole economy. Or
and it
the
will
world
come
economy.
back up again, and the dividends still
you'd
get
expect
paid.
it to. Provided that the cash still comes in the door for the company, you'd expect those dividends to still get paid. But at a higher yield because you're buying low.
Very briefly, what's the fundamental in investing for somebody who has sold a farm or has got some money all of a sudden?
Yeah, so fundamentals are key with investing. So you've got to do your homework. That's the only time.
Go to somebody who can explain it.
That's exactly right. That's the only time in which you're going to get rewarded by the markets. So looking at investing, it's about 50% fundamentals, 50% market sentiment. And so market sentiment being like the media, people talking, all that sort of stuff, and fundamentals being how much debt does that company have relative to assets? How has it been performing over the long term?
Talk to somebody who can explain it.
That's right. Yeah, have a chat to a professional, and they're more than happy to walk you through it.